Barclays is now 11% below its 52-week high. That gap exists despite a £2 billion cost reduction program being publicly on the table. The program combines AI deployment with the offshoring of dozens of London roles to India. That is not a minor operational tweak. That is a structural redesign of how the bank runs its back office. And yet the share price sits at £4.87. Analysts have a target of £5.10. Simply Wall Street flags the stock as trading 44.8% below estimated fair value. The 30-day return is barely positive, around 0.34%. So the question is not whether Barclays has a cost story. It clearly does. The question is why the market has not moved to close that discount. The bull frame for Barclays has been running on a straightforward logic. AI plus offshoring equals lower costs. Lower costs equals higher margins. Higher margins equals a re-rating. That chain is not wrong as far as it goes, but the market has heard it and the price has not confirmed it. Barclays' PE currently sits at 11.3 against a UK bank sector average of 10.3. That premium is narrow, and it is not expanding. The valuation gap to estimated fair value remains wide. At the same time, Simply Wall Street flags 3 structural risk flags at Barclays: low allowance for bad loans, high bad loan levels, heavier reliance on higher risk funding sources. Each of those flags becomes more significant when the bank is simultaneously undergoing operational change. Restructuring execution risk does not price cleanly. It is the kind of risk that sits between earnings reports. What the market appears to be pricing is not that the program will fail. It is pricing uncertainty about whether the savings reach the equity holder, or whether they are absorbed by transition costs, regulatory friction, and integration overhead. That is a different question from whether the program is real, and it is the question this analysis is built around. On the same day Barclays' restructuring headlines circulated, Standard Chartered held an investor day in Hong Kong. The announcement there was specific in a way that most bank AI announcements are not. Standard Chartered said it would eliminate more than 7,000 positions from its corporate function workforce by 2030. That is more than 15% of its 52,000 back-office employees. The roles targeted: risk management, regulatory compliance, human resources, general support. These are the same categories Barclays is targeting with its own offshoring and AI deployment. Standard Chartered CEO Bill Winters described the restructuring in terms that have since circulated across financial centers. He said the bank was replacing lower-value human capital with financial and investment capital. He added, "We don't have job losses, but we do have job role reductions in favor of the machines." Standard Chartered's Hong Kong-listed shares rose 2.5% on the day of the announcement. Investors read the restructuring as evidence of discipline, not distress. That reaction is now the external reference point against which every major bank's AI program will be compared. Here is what makes this relevant for Barclays specifically. Standard Chartered's announcement was accompanied by hard financial targets: income per employee up approximately 20% by 2028, cost-to-income ratio down to 57% by 2028, return on tangible equity above 15% in 2028, and approximately 18% by 2030. These are not directional ambitions. They are measurable thresholds with named years attached. Barclays' £2 billion cost program, by contrast, has not been accompanied by equivalent output targets in the articles available this week. The £2 billion figure anchors the input side of the equation, but the output side, what that £2 billion produces in terms of efficiency ratios or equity returns, has not been publicly quantified in the same way. This is the hidden assumption the Barclays bull thesis requires. The bull case presupposes that the £2 billion savings flow to the equity holder at roughly the same conversion rate as Standard Chartered is projecting. But the two banks have different exposure profiles. Barclays runs a universal bank with a significant investment banking arm. The back-office AI dividend is more cleanly extractable at a bank with a narrower operational profile. That is not a disqualifying difference, but it is a conversion rate question that the current share price does not yet answer. The sector benchmark has been set by a Hong Kong announcement. Barclays now needs to show where its own output targets sit against it. The 44.8% discount to estimated fair value is the number that frames this entire analysis. It is not a small discrepancy. It is the gap between what the model says the shares are worth and where they are trading. Discounts of that scale do not persist by accident. They persist because the market holds an assumption the bull frame does not neutralize. Here is what that assumption appears to be. The efficiency story at Barclays requires that AI and offshoring cut costs cleanly without degrading the revenue base that justifies the cost structure in the first place. In a retail and investment bank, the back-office functions being targeted are not purely inert overhead. Risk management and compliance functions directly support the regulatory standing of the institution. If those functions are reduced faster than AI systems can absorb the analytical load, the bank's regulatory risk profile rises. And regulatory risk at a UK universal bank does not price as a distant tail risk, it prices as an ongoing capital overhead. The second assumption embedded in the bull frame is that the integration of Evelyn Partners, if that acquisition proceeds, adds revenue without complicating the efficiency trajectory. Barclays is pursuing wealth management growth at the same time as it is cutting the operational functions that support complex client portfolios. That is not an impossible combination, but it is a simultaneous tension that the market may be weighing. Simply Wall Street's existing flags, high bad loan levels and reliance on higher risk funding, compound both assumptions. A bank restructuring its back office while holding elevated credit risk and funding vulnerability carries a different risk profile from a bank doing the same from a position of operational strength. None of this means the program fails. The question is timing and conversion. The confirmation signal to watch is the cost-to-income ratio. Barclays' PE sets at 11.3 against a sector average of 10.3. For the discount to close materially, the market needs to see cost savings landing in reported efficiency ratios, not just announced in program targets. When Barclays reports next, the ratio that matters most is not earnings per share. It is whether the cost base is actually moving in line with the program. That is the test the 44.8% discount is waiting for, and that is the variable that tells a current holder whether the standing read needs to change, or whether it has just been confirmed as correct. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.